I'm Tim Bradner. Welcome to Capital Views. Angela Rodell, welcome to Capital Views, and we're talking about the Alaska Permanent Fund. Angela is the Chief Executive Officer of the Alaska Permanent Fund Corporation. Angela, a lot of interest in the Permanent Fund these days, given our state's fiscal situation. Talk of maybe switching to start to use some of the fund's earnings, which have been very substantial. Thank you.
You're welcome.
In place of our oil revenues, which are declining. So a thing a lot of folks are concerned about, though, is oil revenues have been very volatile. We've been caught with some surprises. How dependable are large asset earnings, large investment fund earnings like this? What can we expect?
You know, I think that's a really good question, Tim, because it goes to the heart. We've seen very volatile financial markets, quite honestly, in the last 5 or 6 years, going back to the recession of 2008, 2009, and some of the losses the fund sustained then, as well as what we've seen recently, right, in the last weeks of December into January. So it's a very legitimate question. I think one of the differences, probably one of the biggest differences, is that, you know, oil makes up 90%, production tax, minerals, that type of thing, make up 90% of the state's unrestricted general fund revenue. And in this case, we're talking about taking earnings out of the fund to sort of make up some of that difference. And depending on what strategy you're talking about, it's a different overall percentage. So from the start, the general fund becomes less exposed to one source of revenue right from the get-go, and that's a good thing.
Because the fund earnings wouldn't be able to sustain 90% of the budget.
Correct. The second piece to remember about the fund, and I think this is really key, is that we're a global entity. We invest in global markets. We have exposures all over the world, whether it's in equities, private equity, absolute return, or hedge funds, fixed income, even real estate. We have some of our first real estate holdings that we bought last year in Europe. And so having that broad breadth of economic exposure keeps the fund in sort of a, I don't want to say a flat space, but you don't see the same volatility you would see on something like a commodity as narrow as oil and all the effects that have on oil volatility. So while we may see declines in portions of our portfolio due to the fact that China may be facing a recession today. The fact that the U.S. is doing well sort of beefs up other parts of the portfolio. And so if we look to individual stocks or individual investments, we may see a tremendous amount of volatility, but overall, over the $50 billion fund, we don't see the same degree of volatility we've seen with oil price changes over the last year. And I think one of the evidences of this too is when we look at where we ended fiscal year 2015, we were at roughly $52 billion in the fund. That was up over $1.5 billion from the previous year, up 4% over the benchmark. We don't have December numbers done yet because private equity takes a while to close out. But knowing what we know at the end of November, November 30th, we were flat to the year. And I think that speaks to having an investment strategy that tries to balance out various risks and maximize the return based on what various asset classes and how they respond to various risks and market conditions.
Angela, and you have a target of 5% real return. What does that mean to, now that's inflation adjusted, so to achieve that, you really have to have like an 8%?
Yeah, 7.5%, exactly right.
Yeah. Have you always achieved that?
No, we haven't always achieved that. We've had, I can tell you, we've had years where we've had an excess of 25%, and we've had years where we've had losses in 10 to 15%. So when we look year to year, and just at 1 year, you might see some swings that happen. I think it's important to note all the proposals, as I understand them on the table, are all looking for a smoothing effect by looking at 5 out of the last 6 or the last 5 fiscal years and sort of smoothing that market volatility out, which is something we obviously can't do with oil price volatility and production tax volatility. So that's another reason why, while there will be ups and downs and changes in the amount potentially available to the state general fund, it won't suffer from the wild swings we're seeing like we have the last 2 years.
And of course, that's the way we do the dividend calculation. It's
exactly
an averaging.
Right.
It's an averaging.
That's exactly right. And I think Alaskans are very familiar with it. They've seen it in their dividend, right? We've seen dividends that drop down to $878 and $900 and then have popped back up, and we're already over 2,000 within 2 years. So we have seen the effects, both the benefits and the challenges, but the quickness with the recovery, I think, speaks to why we know we won't have these sort of sustained losses for 10 years of time, or at least I sincerely hope not, because that will be a really bad
Angela,
day.
One final question is, the fund is projected to grow over the years. Where might we be in 10 years if we sustain ourselves to where if we draw financially from it, we do it in a sustainable way? Where would the fund be in 10 years?
Well, I think it's the intent of all the lawmakers and the bills proposed to not truly affect how we manage the fund. And from 2006 to 2015, we doubled the size of the fund. We went from $25 billion to $50 billion. I would expect that we would be up over $100 billion 10 years from now, all else being equal.
That would be wonderful.
It would be.
Angela, thank you for joining us. Tim Bradner, Capital Views. I'm with Angela Rodell of the Alaska Permanent Fund. Thank you for joining us.